Hello guys, welcome to Investing with JYK, and today we'll talk about a restaurant company called Texas Roadhouse. I like this company a lot. I used to be a shareholder. I no longer am. We'll talk about why that is as well. So first of all, uh, this company overall is just a essentially a steakhouse, but like slightly lower end, on par with Outback Steakhouse. And they have standalone buildings in the outskirts of the city. So they're never in the middle of the city. They're always in the outskirts of a city and have their own dedicated parking lot and whatnot. And they serve steaks, some kind of seafood, and the usual stuff like fries and whatnot. I like them a lot. The first time I looked at them was due to the fact that I had one meal in a Texas Roadhouse, and I had a really great experience in the sense that I felt like this place is very efficiently run, and they have a set procedure for almost everything. I'll talk about that as well later. So let's approach this. So first of all, this is a restaurant, and it's currently growing at a fairly reasonable speed. So we can look at their results. So the most important thing about these restaurants is obviously comparable store sale growth. Right, so you can see this is 2017, they were at 4.5, then here's a 3.5, and a 7, and a 4.7, and here was the whole year was, things for this is, I think this is 3.4, and then here you got a 4.7. So essentially like a 5%-ish growth every year since 2012, which is okay. It's not spectacular, but it's also reasonable. They also grow their number of stores. So by now they have, I think, somewhere here, yeah. So they have in US 532 stores. Most of them are company owned, some of them are franchises. And internationally they have 550. And internationally almost everything is a franchise, which makes sense. And so let's think about in terms of future growth. You basically get two avenues, right? One is the comp growth. In this case, let's say it's 5%, maybe, you know, conservatively maybe 3%, on par with just inflation. And in terms of their replications or number of stores, they are still fairly small because in the entire country, they have 500 stores. If you look at Outback, they have, I think, thousands of stores, I think. Let me just find that. Whoops. So Outback Steakhouse, number of locations. Yeah, 1,000 of them. And then you obviously have a bunch of others like Longhorn and Applebee's, which is in a similar range. And if you just think about their density, you could see that, for example, if we look at, you know, just around Dallas, you get quite a few Outbacks here. And if you look at Texas Roadhouse, this is Dallas, you get quite a few fewer. And actually, some more shows up, but you actually get quite a lot fewer stores compared to Outback. So there's a lot of space to grow. Also, this is where they came from. They came from Texas, so that's where the highest density is. If you just, compare Dallas to, let's say, San Francisco, you actually don't have that many. If you just search for Texas Roadhouse near San Francisco, and there's basically just one in Union City. So they haven't expanded to quite a few places in the country. And if you let's say if you look Sacramento, you got 2, and you got 1 here, so like 3. So it's very, very. If we kind of just zoom out, you can see that's the density we get around California. So there's a lot of space to grow. So that the market penetration really is not going to be limiting their growth. And okay, so the other thing that I like is this company is actually the restaurants are really well run. You could see that by just looking at the reviews, right? So that's a 4.5. If you're familiar with restaurant ratings in Google, 4.5 is really difficult to achieve. And then the 4.3, 4.4, 4.3, 4.4, 4.5. So you get pictures. So that's in California. Just in case that this is like a California thing, it's not. You look at in Dallas, it's like 4.5. You can see these numbers. They're all really high. And the lowest I've ever seen on a Texas Roadhouse, I think, is a 4.1. And we could search some other places. Let's say Minneapolis. I'm not even sure there are any, but yeah, you got a 4.4 here. And you can see in the entire Twin City area, you got a single one. So there's a lot of space to grow. So it's really well managed. Just coming from you can see that through just the Google reviews, and that's not just Google. Yelp shows the same thing, and you can see these Texas Roadhouses. They're all 4-star plus. Now, that's all fine and dandy. So let's see who's managing these. How do they get a good management in place? So this guy, this Kent Taylor, is actually both the CEO and the founder. And I checked out all these high-level guys, the executive people. They have really long experience in the restaurant industry. Like this guy's like 25, is like 20, and this guy's a legal guy, and here's another 20 years, and that really shows. Also, one thing I always want to make sure for these companies, is how are these guys incentivized to benefit you, essentially. So I checked their ownership. The most important guy is the CEO. So I checked the CEO, the Taylor Wayne Kent guy. He has 3.8 million shares. Now, that at $60 a share is 3,832,914 times 60.73. That is $233 million. Okay, so is that a big number? We don't quite know, but we can compare against at least to his compensation. So I pulled up his compensation here, executive compensation. All right, so you got, all right, here we go, executive compensation, and you can see he's the highest paid executive. This is paid $500,000. So his equity holding is worth 500, close to 500 times the amount of his his salary. So we can be fairly sure this guy is very well aligned with shareholders. He really, really will want his, increase, a 1% increase in his $233 million holding is gonna just dwarf his entire 2-3 years of his salary. So this is what I like. Okay, so okay, the other things. So I went to quite a few Texas Roadhouse places. We went to at least one in maybe Connecticut once, Texas a couple of times, Oklahoma, and we went to Wichita as well. That was I had that Texas Roadhouse once. We had a couple of times near. We did a trip from LA all the way to Chicago. We had a couple on the way as well. We had some in the we had one meal in the middle of the winter in somewhere in either North Dakota or somewhere. When we went there, we just go to random places, and every single time, the thing I notice is there's always a queue. There has never been a case where there wasn't a queue, and including like 2-3 p.m. and including in the middle of the winter. Actually, I think we also went somewhere recently that was like in the middle of the winter where everything's snowing and there's still a queue. This is just always a queue. The queue is never long. They will frequently tell you there's a 15 to 25 minutes wait, and yet you wait for like 10 minutes or less and you will get in. That has been my experience all this time. And the food comes pretty quick, almost in all cases. The beer glasses are really cold, which is a tiny detail, but that also means like they thought about all the details. And every single restaurant look exactly the same. So they've employed this whole cookie cutter strategy with this construction of the restaurants. And the restaurants always stand alone with a parking lot, and the servers, the waiters are always very friendly and efficient. And the whole decoration is, at the same time they give you a good atmosphere, they're exactly the same, and a lot of them are fairly cheap, but they serve the purpose. So I find like they really know how to spend the least amount of dollar to get the biggest bang. And you can see it's the biggest bang because people love their stuff. They queue up and they give them high reviews, and they're not exactly cheap. So I looked up their menu, and for reference, you could look at, let's see, I think I also pulled up one from Outback. Sorry. Where's my Outback menu? Oh, let's just find one. Outback Steakhouse menu. I remember I had one. Oh, here we go. All right, so we have one here. This is in College Station, Texas. That's not a expensive place, and this is in New York. It's supposed to be one of the more expensive. Oh, it's here. That's why. Huh. Okay. So both. So this is the Outback, and then you look at the steaks, right? And then this one is also Outback. You can also look at the steaks. and this is Morton, is one of the more upscale restaurants, and then you can see they actually sell it for a really decent price. So we tasted a lot of steak. These steaks, in my opinion, should be $40, at least $40. Their bone-in ribeyes, they sell at the 26 for 20 ounce, and Morton's, well, you can see it in here. It's a 43. So I think their steak is slightly worse than Morton's. Definitely a little worse than than Fleming's or one of those, but they are better than a lot of steaks we tasted. And Outback, you can see for the same ribeye here, 22 ounce, it's at $27. But that is in College Station, yes. And if you go to New York, oh, it's Cupertino, California. California is always more expensive. This life in California, you have a $29. So 27.5 divided by 22, you got 1.25, and for Texas Roadhouse, you essentially get 1.3. You got 26 divided by 20 per ounce of ribeye steak. So they're on par in terms of price with Outback. And their review in general is just much better. Not much better. They're at the 4.3 plus range, and Outback is barely touching a 4. So that's essentially how they're the same price point. So I feel like, you know, they're doing something right. Okay, so let's get to the risks. So as a restaurant, a large portion is going to be labor, so the waitresses, waiters, and then the kitchen staff, and then also the food. So in terms of food, the main ingredients is going to be beef. So what we can see is that, okay, beef was a lot more expensive in 2014-ish. But now they're the same price as 2011, so not much reason to expect them to go much higher anytime soon, but the general trend is that they will go slowly more expensive as everything else. And also, the feed on beef, basically corn and everything, might impact the cost of beef as well. And from what I know, corn and all these grain is getting more expensive. We had 3 consecutive record years of harvest, and the inventory of these grains are not increasing much. So so I'm thinking we might be in for some shock if we get just like one bad year and suddenly all the grain will increase in price, and that will drive up the price of beef. That's one risk. So how much risk that is, you can look at the financials. Let's look at here. The cost of goods sold is about 32%. And you can see in those 2 years it was higher, and now it was lower. You kind of can see the increase in this graph here. Well, not the graph, the figures here. And the actual change is quite large, going from $4 close to $6. Let's say 4 to, I don't know, 5 at least. So you're looking at a 25% increase. This is quite significant. And the other one is they sell is actually shrimp. So shrimp is here. You can see there's like a very big bump here, but it's actually not too crazy. So compared to the lows at around 10, now we're at 12.5, 25% more. So yeah, that would affect their profitability if the price of these meats increase. And labor, there's a general trend of labor shortage. We saw a lot of hiring signs when we visited Texas Roadhouse, especially in the recent year and a half, I would say. And that's common across the spectrum. I've seen these signs on almost every single truck that's driving on the road, and I've seen these on let's say Pizza Huts or car washing places. There's a general labor shortage, and then from the unemployment numbers, we know that currently, as of April 9th, 2018, um, we get a like a 4% unemployment rate. So there aren't that many people to be employed at this point. So that should drive labor expenses up. And then you can see the labor expense is actually consistently increasing over time. Well, except 2012, don't know what happened that year, but it's just increasing. But overall, it's still increasing. It's you got a slight decrease of 0.2%, but overall it's still increasing. Now it's 31% of their revenue. So those are all risks. Okay, so the last thing I want to talk about is valuation. So this company is currently traded at some fairly high multiples. I think their multiple, yeah, it's like 33. So normally, if something's trading at 33 PE, I would expect it to grow at least 20% a year. This thing's earning growth is not 20%, I think. It's TTM versus prior TTM's 13%, which is comparable, right? You grow a 5% on your on the comparable sales side, and then you grow another 5% in terms of number of restaurants, and they're not a fast grower. So I don't know why people pay 33 times at 10% growth, factoring in I think they're fairly good in quality. Their ROIC is fairly high. I think their ROIC is close to like 25%. Oh, sorry, wrong. 19%, which is still very high. ROA is at close to 10, and ROE is 15. That's just leverage, but 10% ROA is good. So yeah, so it's a good quality company, but is it worth 33 times? Meh, I don't think so. So, and the other thing is price to book is 5.35, and they are not in a so-called light asset business model. They have to either rent their box, and they have to build it. But either way, they have to redecorate that. This is all money. So it's fairly richly valued. I wouldn't say it's totally insane, but it's pretty high. McDonald's is trading at 25. McDonald's has a bunch more debt than this company, and McDonald's is not growing at all. So comparatively, this is at least better than McDonald's. Maybe that's a pair trade. You can do like short McDonald's and long Texas Roadhouse, maybe. But again, there's this risks as well. So I sold it because it just kind of breached the 30 PE barriers. I found it's no longer a good investment at that price. But the company is really nice. And yeah, this is another anecdote. So the first time I went there was a bug, one of those desert bugs. It was in Wichita or somewhere. That kind of just crawled. I was by myself. I was sitting at the bar. I was crawling, and so I pointed out to the waiter, and immediately they took care of the bug, obviously. And then within 3 minutes, the manager showed up and apologized and gave me a coupon for I don't know, free food or whatever sort. So I was like, well, at least they have that whole chain sorted out. I don't know if there are other things that will change in their management, but this is just it actually turned into an experience from slightly negative to quite positive. You get a really good impression of the place. Like, oh, they first you get the sense that they do care. They show up really quickly, and then it's the manager that immediately showed up, and it's just a good company can turn something that's essentially negative and into their favor. It's a bit like how Johnson and Johnson, I think it was Johnson and Johnson that destroyed all their tablets, all their Tylenol, I think it's Tylenol tablets, I think, right? So and had a good PR. I mean, this is on a much lower scale, but that's still good management. So so yeah, I think. Oh yeah, so there's one more risk involved with the valuation. So we are at an economic expansion, and it's 9 years into it. We almost had a recession in 2015-16, but it didn't really happen. Now, when there is a recession, the first ones that are going to get hurt are the people that are really high end. So the Flemings, or even higher end than those, like Alexander's Steakhouse. They only exist here in California. If you know, they're like, you can get close to $500, $1,000 per meal. It's crazy. But these will get hurt, and then the pain will just get passed down. The one that will get hurt least will be McDonald's, right? So or Burger King. So the ones that are, you know, just feeds you and no frills, they will retain most of their revenue, similar to how Walmart will outperform, say, you know, I think it's Michael Kors or something. So yeah, so keep that in mind. So I think the best time to get in this stock again might be when we have a recession, earning decreases, they stop expanding, they have an earning contraction, and the price of the book goes to maybe 1 or 1.5. And that'll be a fantastic time to buy, because I believe in the management is if they don't fire their CEO, and if they just keep doing what they do, and then it's actually going to be a good thing, because at that point the labor costs will get much lower, and when the economy comes back, they are not very expensive. They are like for 2 people, you can get a really decent meal for about $45-50, including tip and tax. So I think they will, stand in the line of, as soon as the economy grows again, people start spending again, they will be the one that benefited from that expansion, and their multiples will suddenly increase, and their earning will suddenly increase. So yeah, well, hopefully this is useful, and I'll see you next time.